There's a pattern etched into the fabric of financial history that's so consistent, so predictable, it might as well be written in stone. It has played out in Amsterdam in 1637, London in 1720, New York in 1929, and it's playing out right now in 2025. The crash of 1929 didn't just happen. It announced itself 12 to 24 months in advance with warning signs so clear that anyone paying attention could have seen it coming. The same signals flashed before the dot-com bubble burst in 2000, when the Nasdaq plummeted 78% from its peak. They appeared again before the 2008 financial crisis that wiped out $16 trillion in wealth. And here's what should terrify you. Those exact same signals are flashing red right now. Margin debt the money investors borrow to buy stocks has exploded past $1.13 trillion in recent months. That's not just a record. That's a 39% spike in just 5 months, the steepest increase since October 2021. And what happened after October 2021? The S&P 500 dropped 25%. But here's the thing that keeps me up at night. This isn't just about numbers on a screen. This is about a pattern that's older than America itself. A pattern that has destroyed empires, toppled kings, and ruined millions of ordinary people who thought they were being smart. The pattern isn't complicated. In fact, it's devastatingly simple. Every major financial crash in the last 425 years has followed the same 5-stage sequence. Not similar, identical, from tulip bulbs in 1637 to subprime mortgages in 2008. The script never changes, only the actors and the props. And right now, we're in Act 4. The question isn't whether history will repeat. The question is whether you'll recognize the pattern before the curtain falls. To understand how predictable financial crashes really are, we need to go back to where it all started. Not to Wall Street, not to the Federal Reserve, but to a garden in Amsterdam in 1636. Tulips had arrived in Holland from the Ottoman Empire, and the Dutch, flush with wealth from their global trading empire, became obsessed with them. These weren't just flowers. They were status symbols, works of living art that could display rare color patterns caused by a virus that created unpredictable broken tulips. And then something extraordinary happened. Something that would echo through every financial crisis for the next 4 centuries. People stopped buying tulips because they loved flowers. They started buying tulips because the price was going up. And once that shift occurred, once the purchase became about profit rather than pleasure, the psychology changed completely. At the peak of tulip mania in early 1637, a single bulb of the Semper Augustus variety was worth 12 acres of prime farmland or a luxurious Amsterdam townhouse. Think about that. A flower bulb, something that would bloom for a few weeks and then wither, cost more than land that could feed a family for generations. But here is what historians miss when they tell this story. Tulip mania didn't start the day prices went crazy. It started months earlier with 5 specific, observable stages that would become the blueprint for every crash that followed. Stage 1. The innovation. Tulips were genuinely new, genuinely beautiful, genuinely scarce. There was a legitimate reason to value them. This wasn't stupidity, it was discovery. Stage 2. The early success. Some people made real money. They bought tulips, sold them for more, and their neighbors noticed. Wealth was being created visibly, tangibly. Stage 3. The democratization. This is where things get dangerous. What started as a luxury for the wealthy became accessible to everyone. Taverns became informal exchanges where farmers, tradesmen, and laborers could buy and sell tulip futures using a leverage system called windhandel, literally wind trade, because you were trading something as insubstantial as air. Stage 4. The euphoria. This is when "this time is different" becomes the rallying cry. The old rules don't apply. Tulips will always go up because demand is infinite and supply is limited. Anyone who says otherwise is old, scared, or too stupid to understand the new paradigm. Stage 5. The catalyst. It's never a huge event. In February 1637, a routine bulb auction in Haarlem simply failed to attract buyers. That's it. No war, no plague. Just one day when people realized they were holding flowers that cost more than houses, and suddenly everyone wanted to sell at once. Within weeks, tulip prices collapsed by over 90%. Fortunes evaporated. The Dutch economy entered a depression. But that's the curiosity gap that should haunt every investor. Why would highly intelligent people, successful merchants who debuilt trading empires across the globe fall for something so obviously insane? The answer reveals something fundamental about human psychology that hasn't changed in 4 centuries. And it's the key to understanding why the pattern repeats with such terrifying precision. If tulip mania was just an isolated incident of Dutch madness, we could dismiss it as a historical curiosity. But the pattern didn't stay in Amsterdam, it metastasized. Just 83 years later, in 1720, London experienced the South Sea bubble, and this time, the stakes were higher. The South Sea Company promised to assume Britain's war debt in exchange for exclusive trading rights to South America. It was genius financial engineering, turned government debt into private profit. The pattern played out identically. Innovation, a revolutionary debt conversion model that could solve Britain's fiscal problems. Early success, early investors made spectacular returns, the stock price soared. Democratization, everyone from aristocrats to servants bought shares, often using borrowed money. Euphoria. The mathematician Isaac Newton invested £7,000. When asked about the sustainability of stock prices, smart men assured everyone that normal economic laws had been suspended. Catalyst. When it became clear that South Sea's actual trading prospects were non-existent, the bubble burst. Newton lost the equivalent of millions in today's money. His famous quote afterward, "I can calculate the motion of heavenly bodies, but not the madness of people." Now fast forward to 1929. The Roaring Twenties brought automobiles, radio, electricity, genuine technological revolutions. Corporate profits soared. The stock market became the path to easy wealth, accessible through margin loans that let anyone buy stocks with just 10% down. Sound familiar? It should? Investment trusts, the 1920s version of leveraged ETFs, pyramided on top of each other, magnifying gains on the way up. At dinner parties, servants compared stock tips. Economists declared a new era where the business cycle had been conquered. And then came October 1929, the catalyst, a fraud scandal in London that triggered a margin call cascade. Within days, the Dow Jones had lost nearly 25% of its value. By 1932, it had fallen 89%. It took 25 years to recover. The pattern had repeated with clockwork precision. But the conflict isn't between smart people and dumb people. It's between human psychology and mathematical reality. And human psychology has a perfect record. It loses every single time. Consider the mechanics of what actually happens. Phase 1. Genuine innovation creates genuine value. Every bubble starts with truth. The internet really did revolutionize commerce. Housing really was in short supply relative to demand. Artificial intelligence really is transformative. The innovation is real, the opportunity is real, and the early gains are justified. Phase 2. Leverage amplifies everything. Here's where the mathematics become dangerous. When you can buy assets with 10% down, or in China's shadow margin trading system in 2015, with leverage of 20 to 1, a 10% gain becomes a 100% return on your investment. It feels like genius. It feels like you've discovered a money machine. Phase 3. Success breeds imitation. Seeing your neighbor get rich is psychologically unbearable. The fear of missing out isn't new. It was driving Dutch tulip traders in 1636. The only thing that has changed is that social media and 24-hour financial news have made the contagion instantaneous instead of taking weeks. Phase 4. Prices detach from reality. This is the inflection point. Stocks trade at P/E ratios above 200, like the Nasdaq during the dot-com bubble. Houses in Florida swampland sell for fortunes. A picture of a bored ape costs more than a Rembrandt. But everyone has an explanation for why this time is different. Phase 5. The reckoning leverage, which multiplied gains on the way up, becomes a chainsaw on the way down. Margin calls force selling. Selling drives prices lower. Lower prices trigger more margin calls. The downward spiral feeds on itself. The 2008 financial crisis was just the latest iteration. The innovation was mortgage securitization, genuinely clever financial engineering. The leverage was extreme, banks operating at 30 to 1 or higher ratios. The euphoria was belief that housing prices never decline nationwide. The catalyst was subprime mortgage defaults. The result was the worst financial crisis since 1929. Here's the conflict that defines every bubble. At the peak of euphoria, the people warning about the crash are dismissed as pessimists, fools, or jealous losers who just don't get it. Remember that Bear Stearns' CEO said in March 2008 that the firm's balance sheet was pristine. Bear Stearns collapsed 2 weeks later. The conflict isn't about intelligence. Some of history's smartest people, Newton, experienced bankers, successful entrepreneurs, get caught in bubbles. The conflict is between the evolutionary wiring of our brains, which rewards immediate gains, and social conformity and the cold mathematics of leverage, which always eventually demands its due. Let me make this personal. Imagine you bought stocks in late 1999. You're up 300%. Your portfolio is worth $400,000, and you started with $100,000. You feel like a genius. Your friends ask for stock tips. You're thinking about early retirement. By October 2002, that $400,000 is worth $88,000. You lost not just your gains, you lost money you actually earned and saved. Or imagine you bought a house in Miami in 2006 for $500,000 with a subprime mortgage, 5% down. Housing never goes down, everyone says. By 2009, the house is worth $250,000. You owe $475,000. You're $225,000 underwater, and your adjustable rate mortgage just reset to a payment you can't afford. Or picture this, it's October 19th, 1987, Black Monday. You wake up, have coffee, and turn on the news. The Dow has dropped 22.6% in a single day. Not over a week, not over a month. In one trading session, nearly a quarter of the stock market's value has evaporated. These aren't abstract numbers. These are savings accounts zeroed out. College funds destroyed. Retirement dreams postponed by decades. These are people who lose their homes, their marriages, sometimes their lives. The emotional reality of financial crashes is that paper wealth isn't real wealth. It's permission to feel wealthy, permission that can be revoked at any moment. And here's what makes it psychologically devastating. Crashes don't feel like natural disasters. They feel like personal failure. Hurricane victims get sympathy. People who lose fortunes in market crashes get lectures about not being greedy. But the cruelest part? The warning signs are always visible in hindsight. Before the 1929 crash, margin debt had nearly doubled. Before the 2000 dot-com crash, companies with zero revenue were valued at billions. Before 2008, subprime mortgage were being packaged into rated securities. The signs were there, they're always there, but euphoria is a powerful drug. Consider what's happening right now in 2025. Margin debt has surged 39% in 5 months, one of the fastest increases in decades. The P/E ratio of the S&P 500 is well above historical averages. Market concentration in the top 10 stocks exceeds 35% of total market value. AI companies with minimal revenue are valued in the hundreds of billions. Every historical indicator that preceded major crashes is present right now, not some of them, all of them. And yet, walk into any investment forum, read any financial news site, and you'll see the same refrains. This time is different. AI is revolutionary. The Fed has our back. You just don't understand the new economy. It's the same script from 1637, the same script from 1720, the same script from 1929, 2000, and 2008. The emotional trigger is the crash itself. It's the moment you realize you saw the warnings and ignored them. That's when the loss becomes not just financial but existential. That's when you have to face the fact that you weren't special, weren't smarter than history, weren't the exception to the rule. You were just another person in a crowd running toward a cliff, certain that everyone else must know where they're going. How do you protect yourself from a pattern that's been repeating for 425 years? The lesson: the pattern consists of 5 observable stages. Every crash follows the same sequence. 1. Financial innovation creates excess 1630s. Futures contracts for tulip bulbs 1920s. Margin loans and investment trusts 1990s. Day trading and dot-com IPOs 2000s. Mortgage securitization and CDOs 2020s. Meme stocks, crypto, and AI powered everything. The innovation is always legitimate. The problem is what comes next. 2. Leverage amplifies participation. Watch margin debt. When it grows more than 25 to 30% year over year, history shows excessive risk-taking. Current margin debt growth, 39% in 5 months. 3. Prices disconnect from fundamentals. The telltale sign is when everyone has a reason why normal valuation metrics don't apply. Earnings don't matter for growth stocks. Housing never goes down nationwide. Tulips are living art. 4. Euphoria peaks. You'll know you're here when your barber gives you investment advice. Financial media coverage reaches fever pitch. This time is different, becomes conventional wisdom. Critics are mocked rather than debated. 5. The catalyst triggers the collapse. It's never the cause you expect. A failed auction in Harlem. A fraud scandal in London. Subprime mortgage defaulting. The trigger is almost always smaller than the crash itself because the system is already unstable. The trigger just reveals what was already true. The prediction? 3 scenarios for 2025-2027. Scenario 1, soft landing through Fed intervention, 30% probability. The Federal Reserve and other central banks managed to orchestrate a gradual deflation of asset prices without triggering a cascade. This requires perfect timing, perfect coordination, and perfect luck. Given that no central bank has successfully done this in the past 425 years, betting on it seems optimistic. Markets decline 30 to 40% over 18 months, similar to 2000 to 2002, heavily leveraged investors get wiped out. Conservative investors lose paper wealth but survive. Recovery takes 5 to 7 years. The interconnected nature of modern finance, algorithmic trading, derivatives, global capital flows means a correction could cascade into something worse. When margin debt topped $935 billion in October 2021, the market dropped 25%. Current margin debt is higher, and the leverage in private equity and crypto markets is largely invisible to regulators. What you can do: practical defense against pattern recognition. 1. Accept that you cannot time the top. Professional investors with decades of experience can't do it. But you can recognize the stages and adjust your exposure accordingly. 2. Monitor these 5 indicators: monthly margin debt growth, 25% plus YOI is red flag. S&P 500 P/E ratio, above 25 is elevated, above 30 is dangerous. Yield curve, inverted equals recession warning. CNN fear and greed index, sustained extreme greed equals warning. Insider selling versus buying, executives know first. When 3 or more flash red simultaneously, history shows crashes follow. 3. Reduce leverage immediately. This is non-negotiable. If you're using margin, if you have investment property with thin equity, if you're counting on refinancing, unwind it. Leverage is what turns corrections into catastrophes. The 1929 crash wasn't caused by stocks being overvalued. It was caused by everyone owning stocks with 90% borrowed money. 4. Shift to defense before you think you need to. Moving from 80% stocks to 50% stocks and 30% cash bonds when markets are at all-time highs feels like admitting defeat. It feels like you're giving up potential gains. But consider, if markets drop 40%, your more conservative portfolio drops only 20%. You've preserved capital that you can deploy during the crash. Meanwhile, the portfolio that stayed at 80% stocks needs a 67% gain just to get back to even. 5. Develop alternative skills and income streams. Every major crash leads to unemployment spikes. In a downturn, financial capital becomes less valuable and human capital becomes more valuable. Skills that create real value: engineering, medicine, trades, teaching maintain worth regardless of asset prices. The bottom line, the pattern never fails in 425 years of financial markets. The pattern has repeated at least 15 major times. Tulip Mania, 1637. South Sea Bubble, 1720. Railway Mania, 1840s. Panic of 1873. Panic of 1893. Panic of 1907-1929. Crash and Great Depression, 1987. BlackMonday.com. Bubble 2002-008. Financial crisis. China's 2015 crash. And countless smaller bubbles in between. The pattern has a 100% success rate. Every bubble has burst. Every "this time is different" has been wrong. Every crowd running toward easy money has run off a cliff. Right now, in 2025, all 5 stages of the pattern are visible: innovation, AI, quantum computing, leverage, margin debt at records, disconnect from fundamentals, extreme valuations, euphoria, mainstream mania for tech stocks, catalyst. The only unknown is the trigger and the timing. Everything else is following the script exactly. The question isn't whether a crash is coming. The pattern guarantees it will. The question is whether you'll recognize the 5 stages, adjust your exposure, and preserve your capital, or whether you'll join the crowd insisting this time is different, right up until the moment it isn't. History doesn't repeat itself, Mark Twain supposedly said, but it often rhymes. In finance, it doesn't just rhyme. It recites the same 5-verse poem, word for word, over and over again. The only question is, are you listening? Final warning. Financial writer John Kenneth Galbraith noted that the study of money, above all other fields in economics, is one in which complexity is used to disguise truth or to evade truth, not to reveal it. The truth about crashes is simple: they follow a pattern. They're predictable. They're preventable on an individual level, but they're also inevitable on a systemic level because human psychology hasn't evolved in 425 years. We still feel euphoria. We still fear missing out. We still believe we're different. We're not. The pattern is coming around again. The script is being performed exactly as written. The only choice you have is what role you play. The crowd rushing forward, or the few who step aside and watch the crowd rush past. Choose wisely. History is watching. And history has a very long memory.